Welcome back, folks. It's another great day here on Valiant Renegade. Make sure you hit that like, hit that subscribe, hit that notification bell. Share this sucker out on the social medias. And do leave a comment before you head out today. Because this is where Hollywood comes to get put through the business and financial lens of reality. It's time. Renegade Online. Good morning, business and entertainment nerds out there. We have got, we've got another round of earnings season stuff to discuss. And it's been fun so far. We've had Netflix that we covered about a week ago. Good news over there. Netflix, of course, has been doing exceptionally well, considering the VIX, the stock market volatility index. We've seen a lot of things get beat to crap with everything going on, people concerned about tariffs and everything. Netflix has been, except for a brief downturn, has been overall relatively insulated from it because the power of the brand. Now, today we've got another major player in that space. It's a bit of a hybrid model for that space, but it is Comcast. And one of the things we always remind people about Comcast, NBC, Universal, is that they really aren't an entertainment company first and foremost, at least not from a financial cash flow standpoint. They are first and foremost what we would consider to be a broadband company. They're an internet service provider. They are a cellular service, wireless service provider, and they are a cable distribution company. Theme parks and really movies in particular are something of a secondary to tertiary source of income and revenue for these guys. Television, probably the biggest out of that component. So again, we always tell people to bear in mind the way we discuss and the way we react to the market's reaction when it comes to Comcast Universal is going to be very different than a pure entertainment or pure Hollywood play, something like a Paramount or Warner Brothers, or especially a Disney, which, of course, theme parks for Disney are the preeminent source of revenue for them by a long shot, followed by television, and then by the rest of everything else. Now, what we're listening for today, especially when it comes to our analysis and where we think this could go down the road, is hopefully, and we should have, a lot of updates, a lot of talk about the opening of Epic Universe in Orlando, Florida, that's going to kick off in about 1 month from today, about 28 days, if I'm not mistaken, on May 22nd. So we're going to go through all of that. The earnings call for Comcast will begin in about 20 minutes, so stay tuned. You haven't missed anything yet. We always start a little bit early, and we can take an early peek at what's going on here with the pre-market stuff. And again, we don't do financial advice here. We're not here to talk about that kind of stuff specifically, but we do observe what is going on as it relates to our discussion of the entertainment industry. So Comcast, here we are. It's down about 3.68% pre-market, and a lot of that has to do with the what we just talked about, where the biggest source of Comcast's revenue comes from. And as you would expect, no surprise there, the competition when it comes to television distribution continues to be what it is. Those secular headwinds that we always refer to when it comes to cord cutting, right? People canceling cable contracts with their cable company, whether you have Comcast or you have Charter or Spectrum or something along those lines, and people opting more towards the streaming side of things. That's going to have the largest and most outsized impact on what Comcast is doing. Now, they've got some good news on some of the internet side, some of the wireless side, but the broadband side, the slightly lower advertising revenue, which has been affecting everybody the last couple of years out there in the space. Theme parks, again, theme parks are the tiniest portion, relatively speaking, when it comes to Comcast's overall revenues and OI, their operating income or their measure of profits. But we're going to be going through all of this today. Joining me is the executive producer of the Valiant Renegade show and Renegade Online, and hell, the whole Renegade Nation. Jonas J. Campbell joining us here. Good morning,
Jonas
sir.
Campbell Online. I just every now and then I sit through that entire intro and I get hyped.
Well, that's the idea, especially at this time in the morning. I mean, it's 7 a.m. for me. It's 5 a.m. for people on the West Coast. Let me run through this real quick because this will kind of give us some ideas here of what the street is looking at. This is from IBD, Investors Business Daily, always one of my favorite sources out there. And they kind of give us a rundown, and then we'll go into the actual pop-up ads here. Of course, it's not what I was going to say. Comcast earnings top, but video broadband subscriber losses hit stock. Thursday, Comcast reported first quarter earnings and revenue that topped Wall Street targets, but broadband and video subscriber losses came in at higher than expected. Comcast stock fell in the news. On an adjusted basis, the earnings rose 4.5% to $1.09. That's earnings per share. In the quarter ending March 31, revenue dipped 0.6% to $29.89 billion. Analysts have projected a profit of 99 cents on a revenue of 29.8. In addition, Comcast said it had lost, and this is where the key, the gut punch is for Comcast. Comcast said it lost 427,000 video customers and 199,000 broadband subscribers. So you think about this, Jonas, what do you think some of the effects are that would have created something like that? A lot more competition out there, right?
I mean, I wonder if it's satellite providers. I wonder if it's there. I've had people in my area talking about gigabit fiber and things like that. If companies that are more lean and more focused are coming in and undercutting them by sometimes 40 to 50%, I think that Comcast might be a little too top heavy to compete with some of these up and comers. And unless those up and comers are also poorly planning out their cash over the next few years, which is always a issue when you have someone coming in and undercutting on price. I think this is something that Comcast might need a longer term solution.
Yeah, and they do, and they're trying to branch out, and you can see this is one of the areas of their business they've been growing in the last couple of years. In a bright spot, Comcast said it added 323,000 wireless subs, and we're talking about cell phones here, guys. Analysts had estimated additions of 297, so it beat the Wall Street projections by really about 10% or more, or almost 10%. So great job there for them. But when you look at the loss of 427,000 broadband subscribers, right, they cut the cord. They didn't want their cable subscription anymore. 199,000 broadband subscribers, which is their regular internet pipeline, right, cable-based internet. And Jonas, I think what you said is spot on. When you got more competition today than you did a year ago, when it comes to more companies putting in fiber optics in more places. We just had it happen here in the last year, and I switched over from Spectrum to a fiber optic provider that gave me way faster internet for the same price or less that I was paying. That's a big part of it. The other side of it is think of the popularity increase of completely wireless internet solutions like Starlink that have really come on. So there's more options out there where it used to be, you lived in a house, you lived in a neighborhood, in a city, or whatever the case, a suburb, and you had nothing but a controlled monopoly, right? You had one cable provider that had all the infrastructure in place, and if you wanted to get television and internet, you went to that one choice. Well, over the years, those choices have been able to expand thanks to technology. So that's what Comcast is dealing with, and this is what the stock is going to be mostly pushed up and down. And I see people in the audience asking about, do we cover earnings calls for Spectrum and other companies? Well, no. And the only reason that we really don't is because Spectrum is a pure broadband internet and television distribution play. It's not an entertainment play. Comcast we cover because it's got the entertainment play side, because it's got a storied film and television studio. It also has a streaming service that's proprietary to it, and it's got theme parks. So from a diversity standpoint of business model, it's the most close comparison that we have to the Walt Disney Company in total. Although obviously, like we said before, the breakdown of where the revenues come from for Comcast are substantially different than what we get from Disney. And sorry, I'm not fully awake yet. I'm trying to get the second cup of coffee in me. So if I'm fumbling around for words, that's why. We have a new dog in the house. We adopted her 2 days ago, and she decided at 5:30 this morning to wake me up because she had to go out.
I was wondering. I was clipping last night's stream, and I heard an unusual amount of barking. So
yeah, that was it. And I told the kids after, it's like, y'all had to have heard the dogs going cuckoo out there, and was nobody going to get them? So anyway, but this is where we are, and we'll cover the earnings call as soon as it begins. This is not the window I was looking for. This is the one right here. Comcast dropped this about an hour and a half ago. So the first quarter earning results, we just went through some of that story in the article. I will say that although I haven't 100% scrutinized everything, I haven't found any mention in there broken out for Peacock, which Comcast really hasn't been super clear on that. Subscriber growth and all this kind of stuff, I don't know if they're still really reporting it. I know a lot of the industry has stepped away from giving quarterly updates on subscriber growth, which part of me totally understands. They want to get Wall Street off the idea that not everything is based around the almighty subscriber. It's about profitability. But at the same time, it's a little frustrating because I'd love to know how they're doing. They give us a bit of a revenue and income update, but nothing really specific. And Jonas, I don't know if you've seen anything that I may have missed.
No, not yet. I do notice that free cash flow has gone up a little bit. The thing that I find interesting here about Comcast and Peacock in particular is that one of the big analysts who covers Comcast and also covers Disney, his name is Rich Greenfield.
Yep.
He has not said a peep about Disney Plus and the amount of money that they have put into Disney Plus. And he went out on Twitter and said something about the massive billions of dollars that they've spent on Peacock here at Comcast. And he's going after them over and over again. I finally just said, you do realize that Disney is doing the same thing, but no one is watching their shows, right? So I now have confirmation because he liked the tweet.
Yeah.
Do
you have a link to that? Pull it
Disney.
up if you can share that. I'd love to see it.
Been a little bit. Let me find it. It's been a little bit.
I didn't know if that was something today. I didn't know if it was related to this earnings call. It was something this morning. So, okay. But anyway, thanks everybody for being here. Please make sure you smash that like button, the subscribe button if you're not a subscriber here to the Renegade Nation, and do share it out. Share it out on X, share it out on Facebook, whatever social medias that you like. We appreciate that. Totally free. Thanks to everybody for watching on YouTube, as well as those of you watching on X. And we're going to, like I said, we are going to get ported over to the earnings call as soon as it begins here in about 9 minutes. So stay tuned. You haven't missed anything yet. We are just covering the information that Comcast has released. And this information here is what they're going to be discussing during the call. And hopefully we're going to get some more details on it. And of course, the Q&A session at the end, especially for today, is what I'm more particularly interested in, because I want to see how many questions there are. There are going to be a lot of questions about broadband subscribers and what they're doing about that, because again, that is the bread and butter of this company. But I do expect to hear more questions than we normally get for Comcast related to the theme parks, because of course Epic Universe, like I said, opening in about a month. This is a big new venture for Universal, and I would love to hear if somebody asks the question, or if Brian Roberts actually addresses it during the call. So, something like, hey guys, look, we realize, we're facing these secular headwinds. People are cutting the cord. We're doing what we can over there, but we're focused on the theme parks right now, getting these pushed up because, considering the trajectory of what we think, we're opening this park in Orlando, we're opening a park in the UK in a few years. Hey, 10 years from now, guys, theme park revenue may completely replace and exceed whatever losses to that point between then and now, what we see on broadband. This is where Universal, I think, or Comcast rather, is trying to get a little bit more diverse from that standpoint in sources of revenue. But you can see here they talk about, the headlines here. Of course, broadband, wireless, all this is headline stuff. I think there was some mention in here, if I'm not mistaken. I've got to go back and find it. But on Peacock, talking about how the losses were about, I saw a figure of, where is it? Oh, there it is. I see it. I knew I read it this morning when I was trying to wake up. Media adjusted EBITDA, that's earnings before interest, taxes, depreciation, amortization, increased 21%, that's a huge jump. 21% in that profitability metric is massive, to $1 billion. And that was driven largely by Peacock, which is their proprietary streaming service. Peacock revenue increased 16% to $1.2 billion. That would be a year-over-year measurement from the first quarter of 2024 to the first quarter of 2025 that they're reporting today. Peacock adjusted EBITDA losses improved by $424 million compared to the prior year period. Although on this report, I can't find a line broken out. At least I haven't yet. I did not scan it that thoroughly, but I have not found something that shows streaming in its own line item, which is a little frustrating, but I get it. That's how they want to report it. It's not a primary source for Universal, but you can see here you got broadband, wireless, international, residential, and then you've got business service connectivity, content and experiences. You see here you got media, studios, theme parks. In that media, in that 6.4 billion right there, somewhere in there is buried the financials for Peacock itself. So that's the issue, right? Domestic advertising, domestic distribution. At least I believe that's where they hide it. But you know, and this is media increase primarily driven by higher international networks revenue, partially offset by lower domestic ad revenue. Domestic ad revenue decreased primarily due to lower revenue at networks, partially offset by an increase in revenue at Peacock. So all that is in there, but we don't get a full breakdown of what was Peacock by itself. And of course, there's nothing told about where we are subscriber wise.
Yeah, philosophically, this matches with the comments that have been made by Brian Roberts. Like someone will, the famous comment, or at least famous to me, it should be one of his most famous comments. They were asking about Comcast and the profitability of Comcast and the profitability of streaming, and he did reframe that to say, "Look, we've spent hundreds of thousands on streaming, and we've reaped billions." Because of and I think he was specifically referencing the sale of Hulu in all of that, but he frames it as it is another platform that we are using to distribute our content. It is not a business unit. It's the same as if they like Comcast Now or Xfinity Now, the subservice within Xfinity cable, to where they don't break out Xfinity Now as a panel in the same way. They might just to keep their keep their private parts out of the fire, say, yes, we are making money on Peacock.
Yep. And Jonas, I just found it. You want to read that one?
Peacock revenue plus 16%. Paid subscribers increased over 20% year over year to 41 million, with net additions this quarter driven by entitlements from the charter bundle we introduced at the end of Q1.
There you go. So they're at 41 million subs on Peacock. And we always talk about Peacock is, of all the streaming services from a major studio, that's a proprietary service, right? We're not talking about like a Tubi or a Freevee or Roku or any of the other stuff. They're the baby out there. And Peacock, I think one of the reasons why Peacock is able to be more successful, even at their very small scale. I mean, they're a fourth when it comes to subscribers, a fourth the size of Disney Plus. And Disney Plus, when they only had 41 million subs, they were far deeper in the hole when it came to losses and whatnot. Part of the thing is that Universal is not spending just a ridiculous amount of money producing proprietary content for the streaming service. Peacock is basically a digital port from linear broadcast. That's really all it boils down to. I don't think that there is much of any original content that is exclusive to Peacock. There may be a couple of things here and there. I realize sometimes that NBC Universal will take, for example, they experimented with, they took an NFL game and made the NFL game exclusive to Peacock, but the licensing deal for that was, for NBC broadcast, and they're experimenting more with putting things over to that side. The only thing that they really do in terms of proprietary content, or as close as they get to it, is to license their own theatrical content once it leaves theaters, things like Minions, things like Super Mario Brothers, things like Jurassic Park, yada, 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 and they move it down to Peacock for the first 4 months of streaming. But then they collect a big fat check from Netflix and Amazon for the next 10 months because they put that over there, unlike Disney, which just absorbs all of their own content in perpetuity, like we always talk about.
Well, the other aspect is they have incredibly low customer acquisition cost. They know that they have an amazing library of content. I mean, when The Office was on Netflix, it was the biggest show in the world, even with a generation of people who were not watching television or that kind of television when it was originally airing. It's really everything that was making Hulu successful before is now just sitting over there at Peacock. So when somebody says, I want to watch, well, it's not Friends, because Friends is actually Warner Brothers. But if they want to watch any of those old NBC sitcoms, they're sitting there on Peacock. So their biggest draw is their catalog. And all they have to do is keep the lights on in order to make money off of that at this point.
Right. Yeah. And there's been, we'll probably get a little bit more color during the call, but if their revenue increased by that much on Peacock, I want to say that their losses on Peacock right now are probably not terribly big. I mean, maybe a couple $100 million, I would think, somewhere in that range, which again, given the comparison to where Disney was at the same point a few years ago, they got 41 million subs, not 160 million like Disney or 300 million like Netflix. And with streaming, one of the things that we know for sure is that it's all about scale. You've got to have, you have to get to so many subscribers before you can really start thinking about reaching a profitability threshold. And they seem to be getting very close. And I think as they push more content, especially live sports, remember, Comcast just signed the deal to pick up the NBA. And I know the NBA is not as popular as it was 10 years ago, but the point is that it's going to be another live sport element that's going to be, fully packed with advertising, no matter what tier you have, because live sports command advertising. Once that later this year or next year makes its way onto Peacock, which it will, guaranteed, you're going to see more increases for advertising and everything else, more subscriptions. So they're right there. They're on the threshold. They're not trying to reinvent the wheel, with what they're doing over there. They're not spending billions and billions of dollars a year creating proprietary content for the streaming service that would keep them, number one, far deeper in the hole, and two, for far longer. All right, let me switch over. I think they just started their compliance disclosures for the earnings call. So let me, let me get the Chrome tab up for that sucker. That should be it. All right. And we should be off and running. Let me see. Let me unmute it because they had the hold music earlier.
Jason Armstrong.
Here we go.
And Dave Watson. I will now refer you to slide 2 of the presentation accompanying this call, which can also be found on our investor relations
Real
website,
quick, thank you to Araxis for gifting
disclaimer.
5 Valiant Renegade channel memberships. Good morning to you, sir. Appreciate you being here.
And uncertainties. In addition, during this call, we will refer to certain non-GAAP financial measures. Please see our 8K and trending schedule issued earlier this morning for the reconciliations of these non-GAAP financial measures to GAAP. With that, I'll turn the call over to Mike.
Good morning, everyone, and thank you for joining us. Before Jason gets into the details,
I was going to say, is that Brian?
I would like to spend some time on 3 topics that are top of mind: Convergence, business services, and theme parks.
There you go.
Let me lead into those by anchoring the discussion in the 2 overarching elements of the management team's approach to running the company.
They've never mentioned theme parks.
First is that we are focused on shifting our business mix toward growth by investing in 6 areas where we're extremely well positioned: residential broadband, wireless, business services, theme parks, streaming, and premium content in our studios.
Wow.
And we are seeing the effects of this strategy build as time passes. In this quarter, these 6 businesses represented 6% of total revenues, helping drive 2% EBITDA growth, 5% adjusted EPS growth, and $5.4 billion of free cash flow. And second is our proven commitment to our capital allocation strategy, which balances robust, disciplined investment in these growth areas, the protection of one of the strongest balance sheets, if not the strongest balance sheet in the industry, and the return of substantial capital to shareholders. Together, our steady shift in business mix to a diverse group of growth areas, combined with our strong balance sheet, allows for steady execution against our strategy, even as the level of uncertainty in consumer and capital markets has meaningfully increased in the past several months. While we don't see any noteworthy evidence of economic challenges for the year thus far, the odds have increased that challenges may be approaching, but we are well positioned to handle whatever lies ahead. Now let me hit the areas I'd like to comment on more deeply, starting with convergence, where, as we've consistently highlighted, we are structurally positioned to win. Today, we are the only operator offering gig internet and gig wireless ubiquitously to 64 million homes and businesses across 39 states, giving us the largest converged footprint in the country. When you look at just the geographic markets we serve, our gig-capable converged footprint is more than double our competitors combined. And as we've discussed before, our network upgrade plans will ensure that our network leadership and product capability remain ahead of the competition. But the true measure of a customer's connectivity experience lies in its performance within their home. And that is where we excel, given our superior Wi-Fi. Reliable connectivity throughout the home continues to be ranked as the most critical element influencing customers' choice of broadband service, and we lead the industry in delivering this experience. In fact, the latest fixed broadband report by OpenSignal ranks us highest in reliability in our footprint. And we continue to make this Wi-Fi experience even better, an example being the recent launch of our most powerful gateway yet, the XB10, which enables industry-leading multi-gigabit symmetrical throughput and supports up to 300 connected devices with increased speeds and reduced latency. And the importance of Wi-Fi extends to our mobile service as well, as 90% of all mobile data, whether in or out of the home, travels over Wi-Fi, giving us another clear advantage. We have the largest and fastest Wi-Fi network in the nation that delivers unique benefits to our customers with features like Wi-Fi Power Boost, which automatically upgrades Xfinity mobile devices to gigabit speed whenever customers are connected to one of our 23 million hotspots, regardless of their subscribed internet speed. This feature helped us earn the distinction of being the fastest mobile provider according to Ookla's January 2025 Speed Intelligence Report. However, and this is a big however, in this intensely competitive environment, we are not winning in the marketplace in a way that is commensurate with the strength of the network and connectivity products that I just described. Dave and his team have worked hard to understand the reasons for this disconnect and have identified 2 primary causes. One is price transparency and predictability, and the other is the level of ease of doing business with us. The good news is that both are fixable, and we are already underway with execution plans to address these challenges. First are organizational changes. Steve Croney, who Dave appointed as Chief Operating Officer of Connectivity and Platforms, is driving the changes in our go-to-market strategy and other operational improvements with the highest urgency. One of his first priorities was to recruit a growth-focused leader, and we announced the hiring of John Gieselman to the newly created position of Chief Growth Officer of our domestic residential business. With decades of experience at Apple, Expedia, and DirecTV, managing world-class brands in highly competitive markets, John is a fantastic addition to the team, and we're excited for him to join later this month. Second, we are simplifying our pricing construct to make our price-to-value proposition clearer to consumers across all broadband segments. Just last week, we introduced our first-ever nationwide price guarantee for broadband that includes Xfinity's best-in-class gateway and unlimited data for one simple monthly price that is locked in for 5 years with no annual contract required.
That's pretty
Customers
stout.
who sign up for this plan also have the option to add a free mobile line for 1 year. And we are not done. Providing more value to our customers with less complexity and friction is a top priority, and you will see our go-to-market approach continue to evolve over the coming months. Third, we are driving growth in Xfinity Mobile. The benefits are clear as we see an 80% improvement in customer lifetime value when we add wireless service to our broadband-only customer relationships. We started prioritizing mobile attachment towards the end of the first quarter, offering one unlimited line free for 12 months for all new and existing broadband customers who take our traditional and premium level products. This resulted in the best quarter of new wireless net additions in 2 years, bringing our total wireless lines to 8.1 million. And last week, we introduced our first ever premium unlimited wireless plan, delivering gigabit speeds with 4K ultra high definition streaming, more Wi-Fi hotspot data, advanced spam call protection, and a guaranteed device upgrade. And with mobile penetration at only 13% of our residential broadband customer base, we have plenty of runway ahead to leverage wireless as a key component of our connectivity bundle with our industry-leading broadband product. And while we are glad to be underway with a refreshed approach to the market, we anticipate that it will take several quarters for our new approach to gain traction and impact the business in a meaningful way. My second topic is business services, which has tremendous momentum and now accounts for almost 25% of the revenues of our entire connectivity business. We built business services, which is now approaching a $10 billion revenue generator from the ground up, and have consistently outperformed peers with mid-single-digit revenue and EBITDA growth, and with margins in the high 50% range. Within the small and medium-sized business segment, we are the market leader and have done a phenomenal job at deepening customer relationships. We've consistently grown ARPU in the mid-single digits for the last few years, with over half our small business relationships purchasing more than 2 products. We remain excited about the opportunity to continue advanced product sell-in, including our cybersecurity services and Comcast Business Mobile. Within the enterprise solutions segment, we are capitalizing on the significant opportunity to increase our market share and grow customer relationships. We've consistently grown sales and revenue in this segment in the high single digits. Today, our largest enterprise customers purchase over 7 products from us. Connectivity is always going to be the core driver of our business. However, 3 years ago, for every dollar of connectivity we sold in the enterprise segment, we sold 20 cents of advanced solutions. Today, for every dollar of connectivity services we sell approximately 50 cents of advanced services, further solidifying our right to win in the market and providing more value to customers. We've done this through a mix of organic investment and M&A. The Masergy deal advanced our secure networking and global capabilities, and the Nitel acquisition, which closed on April 1st, builds upon this playbook, providing enhanced network aggregation capabilities, increases our channel presence, and provides more robust enterprise solutions. My third and final topic is theme parks, which have been on an incredible growth trajectory, having generated $3 billion of EBITDA in 2024, up from around $1 billion 10 years ago, as a result of significant investment in the business, along with the excellent execution by the team leading Universal Destinations and Experiences. And now we are just 4 weeks away from the May 22nd grand opening of Epic Universe, our most ambitious and technologically advanced theme park to date, with iconic IP from Harry Potter, DreamWorks' How to Train Your Dragon, horror with Dark Universe, and Super Nintendo World. Epic Universe doubles the size of our park footprint in Orlando, transforming our collection of resorts into a week-long vacation destination. We have seen strong demand since launching Epic ticket sales in the fourth quarter of 2024, and the most recent reaction to early previews has been nothing short of phenomenal, with thousands of media stories, social posts, and fan reviews characterizing Epic as having groundbreaking creativity and taking immersive entertainment to a whole new level. Beyond Epic, we're continuing to grow our parks business across the United States, starting with Universal Horror Unleashed, our first permanent
Vegas.
year-round horror entertainment experience, opening in Las Vegas this August. And in 2026, we will debut our first ever Universal Kids Resort in Frisco, Texas. And earlier this month, we announced plans to build our first ever Universal theme park and resort in Europe, with construction starting in 2026 and grand opening scheduled for 2031. This park and resort will be located in Bedford, England, right outside London. The United Kingdom is an incredibly attractive market with its large population, a strong tourism industry, favorable transportation infrastructure, and close proximity to the rest of Europe, especially considering the announced expansion plans at nearby Luton Airport. All these factors make this location an ideal one for Universal theme park and resort expansion into the European market. So those are some of my thoughts to frame today's call, and I will now turn the call over to Jason to provide a detailed overview of our first quarter results.
Wow.
Thanks, Mike, and good morning, everyone.
6
Let me
years
start with
to
a
London.
high-level overview of our consolidated results before getting into more detail on our businesses. Consolidated revenue was in line with last year's first quarter. We've been clear and consistent that we're investing behind 6 major growth drivers, and these 6 grew at a mid-single-digit rate and represented close to 60% of our total revenue in the quarter. EBITDA grew 2% this quarter. Adjusted EPS grew 5% to $1.09, and we generated $5.4 billion of free cash flow and grew free cash flow per share by 26%, while returning $3.2 billion to shareholders, including $2 billion in share repurchases. Now turning to our businesses and starting with connectivity and platforms. I'd like to start with broadband, where the competitive environment remains intense. While we continue to see muted connect activity, we also saw a slight uptick in churn off of record low levels. This contributed to the loss of 199,000 customers in the quarter, while broadband ARPU grew 3.3%, leading to growth in broadband revenue of 1.7%. As Mike mentioned, we feel great about our network position. Simply put, we compete really well against any technology out there. We feel equally great about our position in the home, where our Wi-Fi coverage and control is second to none. And we're addressing current customer pain points and investing in go-to-market with a focus on pricing transparency and simplicity, a unified national approach, and more products translating into more value for our customers. This will require investment in the form of already launched long-term all-inclusive price guarantees and other actions we will take in the coming months. Over time, this will help us mitigate customer churn from promotional roll-offs and better insulate our customer base. On Convergence, we said we would lean into wireless, and the repositioning of our offers during the first quarter were evident in our results. We accelerated wireless net line additions to 323,000 in the quarter, both an improvement year over year and sequentially, bringing our total wireless lines to 8.1 million. And with penetration at just 13% of our residential broadband customer base, we have significant runway for growth and expect continued momentum in subscriber growth in the coming quarters. Wireless plays a growing role in deepening customer relationships and reducing churn. And the structure of our wireless business, with a strong MVNO partnership, industry-leading offloading onto Wi-Fi, and an advantage in customer acquisition as we target our existing base, provides us solid profitability in wireless and the option to reinvest some of this profit as we lean in and accelerate the growth of our wireless customer base even more. At Business Services, both revenue and EBITDA grew roughly 4%. We have a leadership position amongst our peers when it comes to growth in this segment. And our strong performance this quarter was again driven by the framework that we've been operating in for some time. While we're experiencing an elevated level of competition in SMB, we continue to generate healthy revenue growth by driving higher adoption of our suite of advanced services, which deepens the relationship with our large base of customers. Our enterprise segment is an even stronger contributor to growth, and one in which we are just scratching the surface. Earlier this month, we closed on our acquisition of Nitel. This is a great tuck-in acquisition that strengthens our ability to deliver advanced, reliable connectivity solutions, enhancing Comcast Business's competitiveness in the managed services space. Nitel's network aggregation capabilities and network as a service offerings broaden our ability to service our customers, and their indirect channel distribution strategy magnifies our mid-market and enterprise presence. Our results in the second quarter will include Nitel, which we expect will add a few hundred basis points of revenue growth to business services, with a minimal impact on EBITDA growth in the near term. Putting all this together, overall connectivity and platforms revenue in the quarter remained consistent with the prior year, as 4% growth in our connectivity businesses, including residential broadband and wireless, together with business services, was offset by revenue declines in video, advertising, and other. EBITDA grew 1.5% in the quarter, while margins expanded by 80 basis points, reflecting the growth and continued benefit from our mix shift to our connectivity businesses, as well as our ongoing focus on operating efficiency. In content and experiences, there are several key items I would like to highlight. At Parks, we're really looking forward to Epic Universe. All of the early reviews have been spectacular, and we're incredibly excited for the transformation Epic will bring to visitors in the Orlando market. As we gear up for the May 22nd opening, we incurred incremental costs, which landed at about $100 million in the first quarter. This is in line with what we had previously communicated.
Jonas, let's see if the analysts freak out over that one again.
Underlying results in the quarter indicated stable trends in Orlando, giving us confidence that we are entering the Epic launch from a position of strength. In addition, performance at our international parks remains strong and within our expectations, but we are seeing softness in Hollywood due to the aftermath of the wildfires and our proximity to these areas, which impacted our results in the first quarter. And we expect the recovery at Universal Hollywood to be a gradual one. Turning to studios, results this quarter were driven by the strong carryover success of Wicked. After an impressive theatrical run, Wicked continued to deliver great results in premium window sales and became Peacock's most watched Pay-1 movie. Looking ahead, we are excited to launch two of our 3 tentpole releases back-to-back in the coming months. First up is How to Train Your Dragon on June 13th, followed by Jurassic World Rebirth on July 2nd. In media, total advertising revenue was down 7%, mainly due to the volume and timing of sports content, along with tough political comparisons. Excluding this, advertising was relatively flat. While we have not yet seen any impacts from the current macroeconomic uncertainty, advertising is the category that has shown the most economic-related cyclicality in our business historically. However, for the upfront and for the balance of the year, we feel well-positioned in the market as we capitalize on the NBA launching in the fourth quarter, a healthy Peacock subscriber base, and a strong content offering across entertainment and news. Our overall media results this quarter were powered by the meaningful progress we are making in our pivot to streaming. Peacock delivered double-digit revenue growth and a more than $400 million year-over-year improvement in EBITDA losses, in part due to lower expenses compared to last year when we streamed the exclusive NFL wildcard game, but also driven by the improved monetization of Peacock paid subscribers. We ended the quarter at 41 million paid subscribers, with net additions in the quarter driven by the entitlements from the charter bundle we introduced at the end of the quarter. When we launched Peacock in 2020, we anticipated that bundling would become an important piece of the streaming ecosystem. So we pursued a content strategy that would appeal to a broad audience. In addition to our Pay-1 films coming from our studios, over 80,000 hours of entertainment content, including originals and next-day air content from NBC Broadcast and Bravo. A critical piece of that strategy is our focus on sports. Today, we offer more premium sports than any other streaming service, including the NFL, the Olympics, Premier League, Kentucky Derby, Big Ten, and then starting this fall, we look forward to adding the NBA. Summing it all up, our capital allocation priorities are centered on reinvesting around growth in 6 key categories and consistently returning significant capital to shareholders, including $13.1 billion returned over the past 12 months. And we're in an incredibly strong position to successfully execute on tough decisions we're making in the face of elevated competition in certain areas. We've been clear on the benefits of a strong balance sheet, cash flow, and diversification, allowing us to invest consistently through various credit cycles, the pandemic, and importantly, macroeconomic cycles, where we are broadly insulated and positioned to play offense. Our results in the first quarter underscore the success and the consistency of our strategy. We generated $5.4 billion in free cash flow while investing $2.9 billion in capital back into our businesses. At the same time, we maintained a healthy balance sheet, ending the quarter with net leverage at 2.3 times, while returning $3.2 billion to shareholders, including $2 billion in share repurchases. Marcy, now over to you for Q&A.
Amazing to
Thanks,
listen
Jason.
to this.
Operator,
It's so
let's open the call for
responsible and
Q&A,
clear.
please.
Yeah.
Thank you. We'll now begin the question and answer session. If you have a question, please press star, then the number 1 on your touch-tone phone. If you wish to be removed from the queue, please press star, the number 2. If you're using a speakerphone, you may need to pick up the handset before pressing the numbers. Once again, if there are any questions, please press star, then the number 1 on your touch-tone phone. Our first question today is coming from Craig Moffett from MoffettNathanson. Your line is now live.
Hi, thank you. 2 questions, if I could. First, maybe thinking about the theme parks business a little bit. Mike, maybe could you just dig in a little bit more to what you're seeing now? We've seen some very significant drops in international travel to the United States, for example, and some anti-American sentiment even affecting travel patterns. I'm wondering if you can just share what you're seeing with respect to the theme parks and how you think that might impact the 2025 results.
Never had that
even
on Comcast.
with Epic. And then for the broadband and wireless bundles that you're offering today, it's a question that everybody has been focused on the wireless side. You guys are subsidizing handsets. If the price of handsets rises significantly with tariffs, would it be your anticipation that you would increase your subsidies accordingly, or would you expect to pass those higher costs on to customers?
Also,
Get in here, Mike.
Hey, Craig. So it's Mike. I'll
handsets
start
are
on parks and
excluded
then
from the
hand it over
tariffs,
to
so I don't
Dave.
understand this question.
So on theme parks, our first quarter results, continued to be, stable in Florida. We had pre-opening expenses for Epic Universe, but excluding that, underlying trend stable in Orlando. And what we're seeing for advanced bookings, both ticket sales and hotel bookings, are strong for the overall parks and for Epic. So while I see the same headlines you're sort of seeing about airlines and the like, some of that might be outside the window of our booking windows, but what we're seeing continues to be tracking, well. And to your point, some of that is definitely related to the excitement about Epic, without a doubt, where reviews and pre-opening buzz is very strong. And again, ticket sales and advanced plans are, a little ahead of our expectations. And so we feel, right now what we see is continued steadiness in the backdrop for parks. I think one thing that you have to, our domestic parks do draw a lot of folks from the U.S. and a lot of folks from markets in the South, in the case of Florida, that are not necessarily hopping on planes to get there. So there may be a delayed effect between what the airlines are starting to report on and what we see. But like I said, no real sign of that in our business as we sit here now. And then in LA, it's all related to getting LA back to having the tourism industry broadly recovered after the wildfires. And I think the whole market is continuing to see people staying away a little bit more than I think the leadership in LA broadly, or us as a parks owner in that market, would like it to be.
California parks are mostly locals. That's the big
parks.
difference.
And international trends, for Japan and Beijing, stable as well.
Hey, Craig, Dave. So in wireless and how it's positioned within packaging bundling, let me start with, we are a challenger. It's good to be a challenger in any environment, including this one in particular, as I think customers are looking for savings, and I think we're in a great position, and in a really important part of our convergence and packaging approach. Wireless is a huge piece of it, and we just, our new offers at the end of Q1, part of that are having one unlimited line free for 12 months and all new and existing broadband customers, and taking traditional premium level products. So it's resulted in a great quarter to start with. We're rolling here, and we expect continued acceleration in coming quarters with it. So we're leveraging Wi-Fi. It's a different experience with Power Boost and many other things that Mike and Jason talked about. So when it comes to the overall marketplace, the other good part of wireless is source of business, in that we're upgrading the overall base of customers, broadband, into wireless. Their wireless base itself, they're upgrading, and we're a great choice for bring your own device. And so that is an option for us. And all throughout this, we want to be where the customer is.
He
and
didn't
that's
answer
where
that question.
we're constantly focused on that. So when it comes to macroeconomic and other issues, we have figured it out, whether it's competitive intensity. We think we'll manage through it, and we have good offers on devices. We'll see how things go, but our core service offerings provide substantial value, and that is our focus, and we'll continue to
There
be
you
that.
go.
Thanks, Craig. Operator, next question, please.
Certainly. Next question is coming from Jonathan Chaplin from New Street Research. Your line is now live.
Thanks, guys. Just one question from me. I'd love to get a sense in your Project Genesis markets, to what extent you're seeing benefits in terms of stronger growth ads from the ability to offer faster speeds, lower churn, better ARPU, improved OpEx, etc.
Well, it's an important part of our upgrade initiative, and it's helped us. I think a core piece of our strategy is constant innovation and upgrades to existing services. And so it has resulted in upstream speeds, downstream speed increases. And so that has been an important part of our positioning for near term and long term. It's still, as we have a substantial part of our market that has already reached this point. Our main focus, as I zoom out just a bit more in terms of broadband, is really addressing the key pain points that both Mike and Jason talked about. That's where the focus is. The good news is, as you look at things in our network, Genesis being a big part of it, positions us quite well. But broadband customers with us and more broadly across the industry are just doing more. And that's why we continue to invest in the service. It's for the long term. Bandwidth consumption continues to be robust. It was up 10%, per subscriber last quarter. More devices are being connected per household, and every secular trend in that respect is positive. So that's a great starting point. And however, the thing that we've seen and what we're trying to address, we believe there's been just a durable change in the competitive intensity, already intense, but continues to be so. We're really well positioned with our network, Genesis, a piece of it, and our products, but the pain points in pricing transparency and the simplicity and ease of doing business with us, and that's what we're responding to. And maybe one of the main points is with the price lock, equipment inclusions, all in pricing around that, free mobile lines, and some other things that we have coming. So that's our the focus around, and the reason why we're optimistic about where network consumption's going, but nothing specific at this moment in terms of any of the churn benefits related to just Genesis. I think the pain points over time that we're addressing with the new go-to-market approach will be where the benefits will come from.
Thanks, Jonathan. Operator, next question, please.
Our next question is coming from Michael Lang from Goldman Sachs. Your line is now live.
Hi, good morning. Thanks for the question. I just have two as well. First on broadband ARPU, it was encouraging to see the 3.3% growth in the quarter. I was just wondering if you could talk about some of the drivers there. And then, longer term, as you talk about these go-to-market changes, the 5-year price lock, could you just talk about your outlook for what, for the 3 to 4%, longer term domestic broadband ARPU growth? Like what's your commitment level there, and how will some of the new pricing and packaging change this, if at all? Thank you.
Hey, Michael, this is Dave. So, as I mentioned, before, what we're trying to do, really focus on the pain points in this market, and with the 5-year price lock, mobile inclusion, and simplicity of packaging multiple products together. We can execute this tactically, surgically, and do not view it as a broad repricing of our base. We think we can still drive healthy broadband ARPU growth, but these initiatives will require some investment, which in turn will impact our ability to grow EBITDA in the near future, but we view the impact as very manageable. Most important to us is what sits on the other side and how quickly we can get there. And that is a customer base with less pricing friction, even more stickiness, and a huge lever in wireless with our mobile product exposed to a much larger segment of our base, and the ability to migrate this base into a still below market rate that has a lot of upside potential. So we're using this as a moment to get away from a model that at least partially relied on deep discounting up front, but then increasingly results in untenable increases after promotional periods. And we'll have customers that have long-term certainty on pricing over time that is competitive with market rates, which means they're more satisfied, churn at a lower rate, and carry much higher customer lifetime value. And with this, we'll have plenty of room to grow with our customers as they do more on our broadband network and engage more with us in wireless and other offerings. As a company, we've navigated plenty of changes before. This is the right change for our business in this moment and going forward. And it's a change we can navigate in a very prudent way.
Thanks, Mike.
Great. Thank you, Dave.
Operator, next question, please.
Our next question is coming from Michael Rollins from Citibank. Your line is now live.
Thanks, and good morning. 2 questions as well for me. So first on broadband, just curious if you could discuss, how much of the recent losses may be a function of slower industry growth, given the maturation of the category relative to changes in market share, and if you're seeing differences in performance where you're in markets that have had fiber for some time versus those markets where fiber is just getting introduced. And then second, on the mobile side, for the mobile gross adds, just curious if you're seeing a mix shift in terms of the percent that come from existing broadband customers versus new broadband customers, and how you expect the new promotions to influence that. Thanks.
Hey, Michael. So let me start with broadband. I'll get to mobile. The competitive environment remains intense, as we've talked about. You got 3 national providers, fixed wireless. Their net adds have stabilized, looks like, in general, but they're still marketing very aggressively. And as you mentioned, fiber continues to overbuild, so we're dealing with that overbuild. Overall, we continue to see the impact of this, muted connect activity. As Jason noted, did see a slight uptick in churn this quarter compared to the record low levels over the last few years. Churn still below pre-pandemic levels. The churn increase was relatively broad-based, though, as we saw it across our footprint and in all segments and product mixes, but with a little more in mobile substitution impact this quarter. So as that thus, resulting in our actions and the game plan that we have to address our competitiveness and simplifying our go-to-market approach and leveraging mobile even more aggressively than we historically done. We've had some success with buy one, get one. This new mobile offering and including in a package and as simple the way that we have, I think is just going to add a lot of value and provide long-term opportunities in a healthy way in terms of roll-offs of mobile after that first year. So competitive issues are across the board. In mobile, we've seen in terms of the mix a healthy customer base upgrade mix where we have a large upside. The percent of our customers, broadband customers that don't have our mobile product yet, we see that as a huge opportunity over time. That has been our focus of upgrade, but we're also competing fiercely for new customers, and we're well positioned with bring your own device. And these new packages are, I think, going to be very appealing, certainly with the 1 year included, and not asking the customer it's included as part of the package. The other thing too, just to make sure everyone reminding people, we just announced this, that we've rolled out a new set of premium plans in mobile. We're interested in every segment, and we'll compete for customers and broadband mobile packaging. But the new premium mobile offerings we think will help us compete a little bit more effectively in the premium higher end as well. So really good news on that. Really encouraged. It's only been a week or so since we've done it. But that would be, I think, a good option for our base. It would be a good option for existing mobile customers, and will help us compete for new prospects.
Thanks, Mike. Operator, next question, please.
Getting a lot of questions
Certainly.
about
Our next
wireless.
question is coming from Ben Swinburne from Morgan Stanley.
Hey,
Your line
yeah.
is now live.
There's Swinburne.
Thanks. Good morning. Curious if you guys have any update for us on how to think about Peacock losses over the rest of this year. Obviously, Q1, big improvement year over year. Some of that might be timing, but be helpful if you could give us a little bit of an outlook for that business over the rest of 2025. And then kind of sticking with this theme on the pivot in the cable business or connectivity business. Jason, you mentioned the word investment a couple of times. I think, Dave, you did too in one of your answers. We've sort of been accustomed to watching Comcast execute with sort of a priority or focus on ARPU growth, margin expansion, and obviously we've seen the subscriber numbers, come in light over the last year or so. What would you tell us to think about at least over the next few quarters as you roll out these plans? It seems like you're already starting to see some wireless momentum, and maybe there's some EBITDA pressure, but I just thought it'd give you an opportunity to maybe give us a little more help on how the rest of the year looks as you sort of pivot the model in the business. Thanks a lot.
Hey, Ben, good morning. It's Mike. So I'll hit Peacock. I think Jason covered a bunch of this, and you touched on it yourself. But I think looking at what Peacock is and what we've accomplished, continued, strong revenue growth. So up 16% on revenues year over year. That's on the back of better monetization of subscribers. We took a price increase, last year that, stuck, but obviously translates into impact on subscriber growth. We've obviously taken in the Charter subs. So overall, we're scaling up the business and we're monetizing it well. So that drove the $400 million of EBITDA growth together with the move of or the absence of the NFL wildcard game. So I think it shows the power of the team that's running Peacock, and all of us have been focused on it, is to keep driving towards improved monetization and build a product that, we started late, but we started in 2020 with the view that we'll pursue a content strategy that builds on the strengths of NBC Universal broadly. So we've got 80,000 hours of entertainment, including our Pay One movies, Next Day NBC, Peacock Originals, Bravo, and Library. But as we look ahead, we've got NBA coming, and sports has been a very key driver of Peacock with NFL, the Olympics, Premier League, the Derby coming up this weekend, I think, Big Ten, and that's been important in acquiring new subs, getting engagement with our subs, and leading to engagement in non-sports content. So we continue to think that acquiring the rights to bring the NBA back to NBC and Peacock is a big deal. It's a big accomplishment, a big moment. The team is working very hard to make sure, not just within sports, but across entertainment as well, with the new audience that we'll bring in to over the years ahead, and we have it for 11 years, make sure that we use NBA as a launch pad to further scale Peacock and further monetize it. So I won't specifically talk about second half of this year or next year, but I do think expect Peacock to be on a continuing trend of driving towards improved monetization, bigger scale, and therefore declining losses over time. So that's and you zoom back out and you put Peacock alongside the non-SpinCo media assets, where they're hand in glove in terms of the skills, the DNA, and the legacy, together with the rights across entertainment, news, sports, reality, and the like. And I think it's a business that will have some durability to, and an ability to manage as one complete business over time. But I think expect us to continue to look to see improving trends in Peacock as time passes.
Hey, Ben, let me hit the ARPU and profitability question. So taking my cue from Dave and a lot of what he said already, as he said, expect healthy broadband ARPU growth this year. That's what we said on the fourth quarter call. Continue to believe that. But I think the real focus is, setting ourselves up for long-term convergence, positioning, and revenue growth. And I think that's a lot of what you're seeing at this point. So the wireless opportunity plays a big role in that. If you think about our ability to accelerate wireless, which we did in the quarter and expect to continue to do over the course of the year, we're putting in place an expansion of how we're thinking about wireless, an extension of this into the base. 13% of our base has exposure to wireless right now. It's a fantastic product. So we want more of our base to have it. And if you think about the pricing levers we're going to have over time, as you get to the 1-year mark and the 2-year mark, and free 1-year promotional customers roll into a paying relationship that, by the way, is still at a substantial discount to where market rates are. So if they have exposure to our product, they like our product, and then all of a sudden start paying for it, but at rates that are substantially lower than they can get elsewhere, we think that's a very good trade-off and provides for, upside in the future as it relates to how we monetize convergence relationships. I think on the broadband side, Dave pointed to it. As we look at the competitive environment, fiber, is what it is. It continues to creep into our footprint at 3 to 4% per year. That's no change from what we've seen in the past several years. We expect that to continue, but we've competed against fiber for 20 plus years at this point, and it's a very predictable pattern that we haven't really seen changing. It's sort of a pattern where the first 3 years there's significant market share gain, then it levels out, and the patterns we see in those markets, whether it's our own ARPU, churn rates, margins, et cetera, very much resemble our broader base. So it's a segment we know how to compete well against. I would tell you that the newer competitor in the last few years has obviously been fixed wireless. They're adding 1 million subscribers per quarter, so that's sort of the competitive intensity that we're seeing that's sort of incremental. We are competing aggressively with it, but if you think about the areas where fixed wireless has performed well, they're not leading with network, they're not leading with speed, they're not leading necessarily with in-home coverage, but they have a pricing construct in terms of simplicity and ease of doing business that has resonated. That's exactly what we're going after, right? That's exactly what the changes in the last couple of months have been, and you'll see incremental changes from us going forward. So that's the investment activity we're talking about. Dave put some context around that and said, yeah, obviously this is going to make it more difficult to grow EBITDA this year. We effectively said that last quarter. I think that's where expectations are for us already. But the other side of this, when we get through it, is really what we're positioning ourselves for, which is customers that are a heck of a lot more durable. They're on price plans that are sort of at market rates with long-term contractual guarantees, and then a discounted wireless offering that's more broadly exposed to our base. It gives us a heck of a pricing lever over time.
Thanks, Ben. Operator, next question, please.
Somebody ask about the
Certainly.
spinoff.
Our next question today is coming from Jessica Reif Ehrlich
That's what I was wondering.
from Bank of America. Your line is
Here
now
come
live.
5 questions.
Thanks. I guess, excuse me, a couple of questions on media.
It's always a couple.
A couple of quarters ago, you said you were open to a streaming consolidation. Can you give us your updated thoughts on that, and maybe an update on timing of the cable SpinCo? You also announced this theme park in the UK and other parks in the US. Could you talk about how you're thinking about theme parks, like long-term TAM, as you expand into new markets?
Just mention
And
theme
I guess
parks.
finally, I think
Third question.
Jason mentioned that, obviously the industry, not just you, is very vulnerable to this lack of visibility and changing economic environment. Can you just talk about anything different that you're doing in your upfront approach? You've mentioned NBA several times as a big driver for advertising, but maybe talk about NBA overall. Like, clearly you'll benefit on advertising, and it's a positive for Peacock longer term. What can you help us frame the financial impact as these costs go up? Is there a affiliate fee increase that goes along with it? Thank you.
These are all very vague.
So there's a bunch there. Let me kind of tick through those. It's Mike Jessica.
Typical
So
for her.
partnerships on Peacock. I think the point of my earlier commentary on Peacock and what we've built, I think it is fair to say that the broad audience appeal of Peacock, with everything I described, our Pay One movies, NBC Next Day content, Bravo, the library, sports, including NBA, NFL, and the like, makes it a strong element of any future consumer bundle, whether that be through bundles or partnerships. Point is, we're doing our thing to make Peacock what we think the consumer, will be strong in the marketplace. And if opportunities come along to partner up in bundles or otherwise, we'll be happy to consider those things if they make sense. But there's no news to report on that front. SpinCo, your second one, SpinCo continues to no change in our expectation of timing. Around the end of the year. I think UK Parks. I just spent time answering another question, so I won't repeat myself. But I think we
Exactly.
feel very strongly that the returns that we're getting, given our position and strength in the parks business as we know it today, gives us the right and opportunity to deploy capital in smaller opportunities, which are the horror experience that will open in Vegas this year, and the kids park in Frisco, Texas next year. But we've looked around the world. We're always looking for ways to put capital to work in our growth businesses, and the UK opportunity came along, and we feel quite good about the prospects there. But I think to answer the broad question, which is what's our plan for the parks business, I think the plan is to keep driving growth in a business that we think we're one of two players in a market that is within media, not at all exposed to the shift in time on screens from one venue to another. I mean, live experiences, parks experiences, have been thrilling to people, and we think we lean into that and continue to do so. And then finally, upfronts, industry vulnerability, nothing really to add there. I think, we had, all things considered, ad revenue was, flat in the first quarter when you adjust for timing of sports and political. And so impacts aren't yet really seen of the uncertainty that we're observing in the markets, but it may well be coming. So I think we've got a great team led by Mark Marshall running ad sales. I think we're coming up with new products, new ways to leverage all the assets of NBC Universal as we go into the marketplace. And then our content, all of it, but inclusive of the new content from NBA, is going to be a key anchor of what we look to do around the upfronts. And then more broadly, as the future rolls in and we look to monetize Peacock and NBC and Bravo, the stronger the portfolio, the more we deserve to command in all forms of revenue monetization, but no news to point to there today.
Thanks, Jessica. Operator, next question, please.
Thank you. Our next question is coming from John Hodulik from UBS. Your line is now live.
Great, thank you. Maybe back to Dave on broadband. I'm just wondering if the churn commentary that you guys talked about in the quarter and maybe what you're seeing in business, is there any sense that that could be driven by the slowing macro environment, outside of what you may be seeing on the media side, because it doesn't seem like the competitive environment really changed that dramatically as we went from sort of fourth quarter to first quarter. And then digging in a little bit on the business side, is it just small business where you guys are seeing the relationship trends get worse? Are you seeing anything on the government side? And can you talk a little bit about your government exposure after Verizon actually called out a little bit of weakness on the government side, given what's going on spending there? Thanks.
This is Dave. So, talked about competition, a lot. The one thing I'll just highlight, the difference is in uptick a little bit in mobile substitution. That's really, Mike and Jason talked about, the fiber continued, 3 national, the fixed wireless stable, but still marketing, very aggressively. So I think that mobile substitution is the only, difference, and it's just an uptick there. And it is in business services. I'd say it most certainly small business. There's pressure there in terms of relationships, but our strategy is broad-based in terms of revenue generation in every relationship, and even small business. We're adding a lot of products and services to those relationships. Really encouraged by that, and our focus has continued to shift. Having done a nice job in small business to mid and enterprise customers, and that's where we're getting just a lot of traction as we provide complete answers for our customers in those segments, as we do connectivity to advanced services, and adding a new part of the company, Nitel, which is great. So we're very excited about that, but the pressure is in small business.
Thanks, John. That will be our last question from the analyst community. I want to now hand the call over to Brian for some closing remarks.
So listening to all this, let me first comment on broadband and just add my own view where we're clearly facing some challenges. But as you've heard, with a lot of passion, the team has a sense of urgency and energy and focus to getting customer pain points resolved. And while this may take a little time to fully take hold, our history of operational execution success would tell you that while sometimes we may not move first, once we get in motion, we do it extremely well. We have real momentum in wireless and the path to continue to accelerate that. And as we've seen in the market, once it gets moving, it'll allow more creativity in marketing. And we have an industry-leading growth in business services at scale, and our investments to expand the opportunities and grow into new categories and make it a $60 billion addressable market. Very excited about that. And parks, I don't want to belate it, but I just would invite all of you to come visit Epic soon. Bring your family. I think you're in for a great experience. And later this year, on the content side, we have a terrific movie slate, including Jurassic and Wicked, amazing sports with the NBA, as we just talked about, but also we broadcast the Super Bowl, the Winter Olympics right at the same time, and the World Cup, which puts us in a very enviable position. So I really like our strategy, our balance sheet strength. Regardless of global uncertainty, I feel we have a fantastic and unique company, and I'm quite optimistic. Thanks, everybody.
Thank you, everybody, for joining us.
There you go.
Thank you. That concludes today's
All righty.
conference call. A replay of the call will be available starting at
Let me,
11:30 a.m. Eastern Time today on Comcast.
Pull that down. All right. So, lot going on there. Nothing on the broadband side for cable and internet that was super surprising. We know they've been trying to shift some of their strategies there, and that is their bread and butter. But I do appreciate how they said, look, one of the biggest impediments we found, it's the customers out there, the people that view Comcast and the services that we deliver in that side. They rate us as best in class, most reliable, in the home, internet, Wi-Fi, in the footprint that we have. That's 60 some odd million people that they said. They said the problem is that the impediment for folks was they didn't like dealing with our customer service. I'm paraphrasing. That's kind of it, right?
Yep.
So they said we're looking to totally revamp that. We're working on that right now. We're streamlining this and that. We're going to give people the ability to lock in a price guarantee for internet for 5 years with no contract, I believe he said, so they can come and go as they please. Trying to expand the wireless cellular service with that, giving them service for a year. So look, I mean, from that standpoint, that's a much more difficult business that's affected by components largely that are beyond any one company's control. It's referred to as secular headwinds, right? The cord cutting, people just canceling cable contracts and just picking up streaming services. They have to adjust like everybody else. Spectrum's kind of in the same boat, not really much different from Comcast. The difference with Comcast, the advantage for them is they have these other arms of business. And these other arms of business, like television, broadcast television, linear and over-the-air cable. They've got a streaming service. They've got a major film studio with Universal and a very rapidly burgeoning theme park section of their overall portfolio that's about to get a lot bigger in a month. And then next year with Frisco opening later this year, with the small park with Vegas opening, international opening in the UK. So there's quite a bit going on there. And then I did find, I was looking for the supplement report. Comcast puts out a number of publications to go with each earnings call. There's like 4 different things to click on. I'm like, I know it's got to be here somewhere. I did manage to find it. But before I pull it up, Jonas, what were your kind of initial takeaways on this?
Well, they're really swinging around wireless and I think they're effectively utilizing it. Time will tell whether or not that's the case here. It's an MVNO deal, which, if anybody doesn't know what that means, they rent space from other carriers. I'm not sure what the carrier is in this case, or if it's multiple carriers, but that is not a business that they own outright. They have some kind of deal in order to get access to someone else's bandwidth. That part makes me more nervous than anything else, that they don't actually own that bandwidth. But it also means that they're not in for all the infrastructure costs in building that, and they seem to be using it effectively as a little carrot to get people to stay with them and to try to get people to bundle, increase the stickiness of they use stickiness. I like friction. Exit friction is my more favored term here, but also working on customer service at the same time. Comcast has already come a very long way on customer service. They used to be the absolute worst in customer service, and they would aggressively go after you for things that were not your fault if you ever tried to leave their service. So I think this is a company that has really worked hard to try to improve its image, try to improve its value proposition. And it's not just we're so down on Disney, but the call itself, as always, is more grown up, more measured, more clear and transparent with the audience, and of course with the analysts who are actually talking with them. So they'll even say, "We've already answered your question, we feel," when something ridiculous is thrown out. Meanwhile, Disney gets softball after softball. I don't understand.
Yeah, there does seem to be a big difference, right? They kind of pound and pepper away at things. That we joked, what was it, a year ago, Jonas, or thereabout, when they announced that they were going to have about $150 million of pre-opening costs and advertising associated with Epic, and we got 3 or 4 analysts asking questions about that, like it was some major concern. When do you think this? Oh my God, this cost of $150 million. Meanwhile, the Walt Disney Company will crap $300 million plus to $400 million down. Movie after movie after movie, like Snow White, that fails miserably, and it's cool.
Yeah,
it's like I don't get this. But to the point, I wanted to bring this up, and I see my StreamYard is stuttering. I know we were having issues last night. I don't know if I look good to everybody out there in the audience.
I'm not seeing any problems, but maybe the audience has got a different
Michelle was having issues last night. I can't tell, but I'm getting a little bit of a stutter here for some reason. But just to bring this up, this is what I was looking for earlier. I knew it had to be somewhere. The actual financial report is one thing. This is another supplement that they had on the website. So I highlighted down there just to kind of draw your attention to it. People asking about Peacock, and I wanted to bring this up. You hear the word scale a lot. Well, Peacock paid subscribers, they've gone from at the end of fiscal year 23, 31 million to 36 million, now at 41 million. So basically, I mean, you look at that in a quarter, they went from 36 to 41 million. So that was an addition of 5 million subscribers between January 1st and March 31st of this year. And a lot of that had to do with putting some of the NFL stuff over there. Like they said, the wild card games, they talked about the change in advertising, things that they were doing. So that's a huge jump. That's a massive jump. And this is what we're talking about with scale. If you look right above it, Peacock, here's the actual revenue stream, right? 3.369 billion back in 2023 for the entire fiscal year was the revenue. 4.93 billion for the entirety of 2024. So that's a big jump. That's about a 30% jump, 33% jump from 23 to 24 in total revenue. And again, with a relatively small subscriber base, basically the smallest subscriber base of any of the major proprietary streaming players in the industry. And they've already got $1.2 billion in revenue this year. That's on the first quarter. And the reason I mention this is because, again, when you look at the total revenue for Peacock as a streaming service, and then if I'm to go down here and we go down to the cost side of things, right? We look at the cost that they had. Actually, let's go down here. Adjusted EBITDA. This is what I was looking for. It's on a third page. Peacock right there under total content and experiences. You can see that the losses have greatly reduced in fairly short order, especially when you consider how small they are. Scale's important. The more subscribers you have, the more revenue sources, the more subscribers that you are able to spread the costs over, right? They're still only 30. They were 31 million 15 months ago in subscribers. Now they're 41 million today, or at least at the end of March 31st. And they've gone from a $2.7 billion annual loss in 23, 1.8 billion in 24. This quarter, the losses were only at 215 million. I cannot stress enough, you cannot do a direct comparison to Disney Plus itself or Disney DTC per se, because Disney Plus, again, they had a $215 million quarterly loss at Disney Plus like 3 quarters ago when they had 100 some odd million subscribers. Peacock is showing a $215 million quarterly loss on streaming with a fourth of what Disney has for streaming subscribers, not including ESPN, right? We're just talking about the entertainment side. We're talking about Hulu and D+. A fourth of the number of subscribers of Disney Plus. And that's a good number. And the reason why that should make a lot of Wall Street happy is to realize, well, look at how fast the subscriber growth they're getting right now is. Think about what's coming. They just mentioned later this year, whatever you think of the NBA or not, whether or not they have gone down, and they have, obviously, they've lost a lot of viewership in the last 10 years. They still have a pretty big damn viewership base. It's still a major live sport, right? A lot of those people are going to be showing up to Peacock to watch the 30% of the games that Comcast secured for NBC for the NBA starting in the next season. You got the Winter Olympics, Super Bowl, all this kind of stuff. You can guarantee yourself that most, if not all of this, is going to wind up co-broadcasting or streaming on Peacock. And I know there's some questions out there in the audience about, well, why doesn't Peacock just shut down and turn everything over to Netflix? They literally can't, because a lot of what's driving Peacock right now are the live events. And there's going to be more and more and more live sports. When you look at the repertoire of live sport broadcast contracts, the licensure that NBC Universal holds, it's basically second only to ESPN. NBC and ESPN are pretty much tit for tat in terms of the amount that each of them hold. Now, you think of ESPN because it's an exclusive sports network, right? Disney, ABC, but NBC has a huge swath, right? Because they don't just broadcast on NBC. They've got other channels that they deliver through cable that also will broadcast some of these sporting events. But I mean, NBC, they're talking about Big Ten in college football. There are only two conferences left in college football that matter. There's the Big Ten and the SEC. And both of them have enormous fan base and audiences that watch college football. I mean, forgetting even basketball and baseball for a second, just college football in the fall. ESPN Disney has the SEC. NBC has the Big Ten. And you're going to see more and more and more of this stuff driven onto Peacock. And what they're talking about is, hey, we broadcast a show on a cable network or NBC on a Monday night, and by Tuesday, it's over on Peacock. If it's a live event, like I said, it's often co-streaming or it's simultaneous casting with Peacock and linear. So with an only $215 million loss right now, with only 41 million subs, and that was at the end of the quarter. At the start of the quarter, they had 36 million subs. So just take an average of that. If they had a perfectly linear growth through the quarter of subscribers, so let's say they had an average of about 38.5 million subs in that quarter. To have only a $215 million loss with everything that we've seen over the years with Disney and Paramount and Max and even Netflix many years ago, dude, honestly, that number is good.
Yeah,
that's
it's fantastic.
Really good.
It's slow and steady. And Disney's over here talking about how they're going to do a new ESPN streaming service before the end of the year. Yeah. And that is, they're talking about, they have not said what the pricing will be, but realistically, it's probably going to be $40 to $50
has to
a
be
month.
40. Yeah.
And Comcast is over here just quietly offering value. They don't seem to be breaking the bank in order to get some of these contracts. And they just have one streaming service, so there's not this confusion between, well, do I have to get the bundle in order to get this? I think Comcast's slow and diligent strategy here is very critical to their success.
Right. Think about this, and you just mentioned a great point. I didn't even think about that, and that is that their model here with live sports versus ESPN is strikingly different. ESPN, like you said, they're going to have to charge, and we've all said this, it's going to have to be $40 to $50 a month. There's no way around it, because as they continue to lose cable subscribers, right, they're getting about $10 a month. Disney is. They probably attribute to ESPN, but they're getting about $10 a month from everybody's cable bill. But only about 30% of the people that pay that cable bill, that basic cable bill, actually will watch stuff on ESPN. 30% or less. And the problem is, in order to make that up with an exclusive ESPN subscriber, well, you can't charge $10. You're going to have to account for the loss of people that aren't watching it but are still paying for it. So that's why it's going to have to be $40. But now, in the beginning, they may come out with special pricing. They may come out with $20 or $30. But I promise you guys, it's not going to stay there for long. But people have had to pay for ESPN to watch Disney's sports offering, barring it being broadcast on ABC like Monday Night Football used to be exclusively, right? People are used to paying for it. With NBC's sports broadcasts, by and large, they don't. NBC is over-the-air broadcast, just like ABC. And most of the bulk of their, think about this, the NFL games that NBC broadcasts, which is usually Sunday Night Football, that's been on NBC. It's been on an over-the-air station for years. If they are putting stuff, think about like the Masters, the golf tournaments and all that, over-the-air broadcast. When they do a lot of Big Ten games or they do Notre Dame games, they are generally on NBC. They are over-the-air broadcasts. It's not a premium service. They do broadcast certain things on their like USA network, right? NBC will broadcast some sports events over there, but they tend to be more few and far between. Their model, in other words, is already set up for just pick up the regular streaming service with everything on NBC on it. Because we're still going to have advertising revenue. We're not, we don't rely on $10, $12 a month revenues from cable providers for an exclusive sports channel right now. Not really. But if they're able to put most, if not all of this over to Peacock, depending on how the contracts work for licensing, again, they're in a much better position because Disney is going to have to launch an entirely new streaming service all over again with ESPN, because ESPN Plus is not the same thing as what Disney is going to. I mean, you've got 8 different ESPN channels. If everything's going to be available over there, think of how often people really watch that. I think the ESPN service is going to have an enormous rate of churn. You're going to have
amazing rate of churn
Yeah.
because once someone's sport is done for the season,
exactly
no one has any reason to subscribe
3
to it.
months, 4 months, right? I mean, that college football, NFL, you're watching that for 4 months and then you're out.
And by the way,
Unless
for those of you who are wondering about this analysis comes from Bob Chapek himself to say, we know the light users are never going to pay it. We know the mid users will go over to their friend's house, and the
Right.
heavy users are the only one that's going to pay. So we have to raise prices by a factor of 300%.
Yeah. I mean, there's no way around it. But I said, when you look here at where Peacock is, and they just started fiddling with, major regular seasonal live sports on Peacock. They haven't even really kicked the door open. And again, to remind a lot of those costs, think about this, and this is key. Think about the losses that accelerate on Disney Plus over the years, right? What is Disney doing? They're spending 100 million, 200 million, 300 million. Andor just came out this week, over $650 million for 2 seasons of Andor that we know of so far. That's the problem. They're also consuming all their own content exclusively from theaters, like we mentioned earlier. Where are the big or much of the big costs frequently being attributed to Peacock? Well, one reason is anytime they port over a live NFL game, a playoff game, Sunday Night Football, the NBA later this year on Peacock, they are going to attribute part of that $2.5 billion a year that they've traditionally attributed to just linear broadcast, NBC itself or cable stations. Part of that contract now is going to be ported over to Peacock. So they're going to take some of the expenses there. They're not generating hyper expensive, all new exclusive content for Peacock. They're taking costs that are already on the books. Much like, if y'all remember, everybody complained up and down when Bob Iger did it, like he was taking some of the costs for some of the shows that were being broadcast on Disney linear cable stations because they were co-streaming them over on Disney Plus. So he said, well, wait, let's take some of the costs. I mean, let's not take the write-off exclusively over here with linear. If we're also putting it on Disney Plus, let's take some of the costs off over here, right? They're all doing this, and Peacock is as well. But what they're not doing is spending $300 million on exclusive content, and they're still collecting big, fat, massive checks from Netflix and Amazon that also get to license their content during the pay one window after it leaves theaters, and it's soon to be exclusively Netflix. This is the big difference between what Disney is doing and what, in this case, Comcast is doing in relation to streaming. They have a much smarter model. And Disney, in hindsight, go back and look if you don't believe me, when Disney only had 40 million subscribers for streaming, they wished that their losses would have only been $200 million in a quarter.
Amazing.
Because they were 4 times that much.
I think that Peacock is going to be profitable for them soon, even if you don't account for the fact that they sold off Hulu and all of this stuff. So
right,
there's that'll probably come out as a unusual transaction, or oh man, I forget what the actual business term is, but I think streaming is just we're also doing that. It'll be profitable eventually. So
yeah, I think that's what it boils down to, really. Let me grab some of these supers that came in. Mac had posted this: avoiding $300 million per season shows is a good business strategy. Yes. Mm-hmm. Yes. Hence Peacock showing actually really good numbers for being where they are. I mean, now, if think about this, Disney last quarter or 2 quarters ago were bragging that they were, I think, maybe 100 million or something over the top. And then this last quarter, they were positive 400 million on streaming, Hulu plus Disney Plus combined. And again, 160 million subscribers. Peacock is only about 500 to 600 million behind them when it comes to profitability, and they've got 1/4 the number of subscribers. Scale up Peacock. If it were 160 million subs right now, they'd be smoking Disney Plus. I mean,
They're
in
also
terms of
not lowering
profitability.
prices at this point. They're raising
Right.
prices slowly at this moment, while Disney is really they keep renewing that $2 a month for the bundle deal.
Yeah, I can't wait to see what kind of impact that's going to have on their report here in 2 weeks. Haywood is here, became a YouTube channel member. He re-signed up at the Insurgent level. Also gifted a Valiant Renegade channel membership. Thank you, Haywood. And Nightwalker gifted a Valiant Renegade channel membership. God bless you, sir. Thank you. Experiment 626. Epic Universe is going to make bank when it opens. Dark Universe at night is amazing. And I know he was also in the chat talking about he's going to be going back out there to Epic this weekend. I've been trying to get passes. Somebody want to send me some tickets to get there before May 22nd. I want to go see it. I really, really do, because otherwise it's going to be all the way till January, February next year. So Nightwalker Medicine for 5. Good night, all. I'll catch the rest on replay. Hail Jonas, VR, and the Renegade Nation. Thank you, Nightwalker. Angela Richter says, late this morning, but I'm here. Thank you for being a member for 2 years, Angela. We appreciate you so much. Mike is here for $5. Oh, so this is what an earnings call is supposed to sound like. F my Disney stock. So, yeah, sorry, Mike. You get to come complain about Disney in 2 weeks. Butterbiscuit 410, killing me VR with these streams that start before I even get to the office. And this is twice in a row. You make us watch a fake call. It's obviously fake because there's no artificial intelligence questions on it. For those of you that don't get it, he's being sarcastic because during the annual shareholder meeting, Bob Iger loves to, they don't let any shareholders call in. Now, this wasn't an annual shareholder meeting, obviously, but yeah, we love to joke about Disney because Bob Iger does not want anybody throwing him any kind of questions that make him look bad. And yeah, so they keep tight controls on that. But other than that, I mean, I thought, the discussions about Epic Universe, one of the things they said, and I don't know if you caught this one, is during the Q&A, there was a question about Epic. I don't remember exactly what it was or who it was from, but the response from Brian was, our pre-sales are actually exceeding our expectations.
Mm-hmm.
They already had pretty darn good expectations. Again, to remind folks, they were talking about expecting, and we knew they were being conservative. This is what they said publicly. Now, internally, they may have had a different number, but publicly, they stated that they were expecting somewhere around 10 million visitors in the first 12 months to Epic, just Epic Universe, not all of Universal Orlando, just Epic. So, according to what was said today, those expectations appear to be exceeded at this point. Now, by how much is the question. I think, and I've said this before, I said I would imagine in the first 12 months, they'll probably blow through that 10 million pretty quick. I'm thinking probably closer to 12, because especially there's not many people that's been in there yet, but the discussion has been amazing for it. People are psyched, but we haven't even gotten the general public in there yet. We haven't even had a summer take off yet, and that's going to spread the word even further. So there's going to be a lot of good things coming. I'm going to be really interested to see where we are a year from now. Heck, even just 3 months, 6 months from now, after we have a full summer, to get a report from Comcast to say, hey, we had 7 million people visit that park this summer, just in 3 months.
Yeah,
I don't know.
And it's interesting, and I don't want to completely discount the question that they got right at the start, even though it was blatantly political. Hey, what about the international travel situation? First of all, it's an Orlando park, so yeah, that fully acknowledges that. Also, they have a Bedfordshire theme park that they're working on now. That's not for 5 years or something like that, and also tariffs. So it was tariffs and international travel. How is that affecting everything? Well, looking at the window we have now, it's not affecting anything at all. Was essentially their answer.
Exactly. And again, remember that answer 2 weeks from now, when probably we'll get a relatively similar question asked to Bob Iger at Disney. And of course, the big difference between Disney in Orlando and Universal in Orlando right now this summer is what, Jonas?
That they actually have rides and quality. I'm sorry, it's the difference between Disney and I was looking at something in the chat.
No, that's all right. I was going for the opening of Epic. There is there is a big new thing that Universal has that is driving traffic in to go, I want to go anyway.
Disney has nothing for several years now. The only thing they have on the horizon right now is a Cars Land, which is a repeat of what is out in California. They have Villains Land. Those are years away. And Disney is promising they will do something. This year, they have a new Villains show coming to the end of Sunset Boulevard there over in Hollywood Studios. That's all they've got this year. It's nothing. Oh, and they're going to redo Smuggler's Run for next year.
I saw that. They're not redoing. They're just adding a new video into it.
No, they're
when you
actually
get in the ride. It's going to be.
It is a huge technological upgrade because they're upgrading the entire thing to Unreal Engine 5. The problem is that is the worst since Fast and the Furious Supercharged is now closed. The engineer seat on that ride is the worst ride in Orlando right now.
Oh yeah.
So
yeah, that is I was in that seat when I rode it.
Me too.
Is garbage. The whole ride is trash. Honestly, I thought the whole ride was stupid as hell. It's really not that fun. Especially. You would have thought they would have built something more robust for a Star Wars ride, but
Star Tours beats it every day of the week, and that's a 30-year-old ride, more than 30-year-old. Yikes!
Yeah, but that's just it. There's nothing driving audiences to go see Disney except for the Disney fanatics. Which I'm sorry, I mean, like it or not, Disney had better understand that is a dying breed. Because they're not being replaced. There are no new younger generations coming in to that are getting hyped up for it. I mean, yeah, parents will still bring their kids, but I don't think we're going to have the same level of Disney adult 20 years from now that you have today. And that's the problem is that Disney is depending more and more and more on the Disney adults than they are actually children. And we talked about this, at least tacitly last night during the live show, talking about how, hey, the big headline thing now for their brand new Star Wars show is a scene where somebody gets sexually assaulted.
Yeah, it's mental illness and trauma. That's what they've got right now. And it's heavily political on top of it. So, you've taken Star Wars, which was the most appealing American franchise in the history of cinema, and you've turned it into something that has a niche, heavily political, and tied to mental illness appeal.
And cost $700 million.
Oh my!
For 2 seasons.
I still like for as hard as we get on Amazon for Rings of Power, this was not tied to the acquisition of a huge IP. This is just blowing more than $300 million a season.
It's insane. It's
insane.
Clinically insane.
On something that no one watches because they. I don't know. I could rant about this for a very long time. That Disney refuses to just cancel something at this point.
Well, and it brings up one last thing I wanted to mention here is that this is the difference. You hear the calls like today, and they're asking Comcast about, what are we doing with this? What are we doing with that? Comcast is usually pretty responsive, when they say, hey, we found out that people don't like this about us. We're actively working to fix that, right? They acknowledge what's broken, and they talk about basically, hey, we screwed up. And we're going to make our customer service better. We're continually making improvements over there. We want to keep doing that because we want to make sure that, hey, people are happy with us, so on and so forth. It's easier to get behind. Okay, everybody makes mistakes. We're all human. But being able to admit it. I mean, how many times, however, do we ever hear Disney or Bob Iger come out and flat out admit, yeah, we really whiffed on this? They don't, and that's the difference. And nobody ever challenges on them. And again, this was one of those stories. You sent me this yesterday. I didn't get to this last night, but just as a perfect example, kind of going into how the discussion went today with Comcast, acknowledging errors. Here's Warner Brothers. And this wasn't the director. This wasn't some rando on the production set, right? The actual studio chief here. We misread the room on Joker Part 2 with the musical that totally bombed. We completely misread the room. So this is kind of the point, right? Is that they get it out there. It's, hey, we screwed up, man. We whiffed on this one completely. This is the
And
kind of attitude that
they
you
have
need
the
at
room
Disney
to
right
say
now.
that because
Right.
Minecraft did so much more than they expected. I remember,
Right.
and speaking of last night's panelists, I was around Michelle and Natalie when that came out, and
Mhm.
their description of the movie, you could tell that they were still trying to comprehend how it could have turned out so bad.
Yeah. And that's just it. I mean, you've got the people at the studio here, Mr. DeLuca and Abdi. The negative press began with the box office failure of Joker, and they're not deflecting the blame. These are the studio heads. They actually admit the film's failure was on them by skipping test screenings in favor of a cozy friends and family viewing party. They misread the room. Now, if you think that sounds like Disney, you're right, because that's what Disney used to do. They used to bring in the Disney staff members and all this, and they would get what you'd expect for Disney feedback. Everything is wonderful at Disney. All the farts smell like roses and sugar. And they didn't actually get a real read on a film. And I love the fact that you've got the heads of the studio over there saying, we completely screwed this. This is totally on us. This was bad. Do you think that Alan Bergman or Bob Iger is going to walk out and say, we completely effed up Snow White?
No, they have a culture of terror around there. You're not
Yeah.
allowed to say what's wrong, and you probably should never admit that you screwed up.
Yeah, and this is, they go to the stories last year. Deadline reported the studio also, quote, appeased director Todd Phillips' requests by giving him, quote, final cut on the film, agreeing to a world premiere at the Venice Film Festival. They said they were thrilled with an early cut of the movie. DeLuca and Abdi at Warner Brothers, the studio heads, were thrilled with an early cut of Joker 2. Full on, quote, this is genius mode. David Zaslav, however, I always tell y'all, never count out David. David Zaslav, however, was not convinced and didn't hesitate to voice his doubts. And now DeLuca admits that David Zaslav was right all along. I love this. I love this.
I've got someone that I've spoken to that's familiar with how the executive situation at Warner Brothers is right now. And I think Hollywood just absolutely hates the Discovery people, including David Zaslav.
Oh, they hate Zaslav with a passion. They always have.
The chief people person. First of all, you have the separation of the HR department, which they call like people officer or something like that. And they've moved DEI out of HR. They've separated the function where it used to be combined not that long ago. Their chief people officer was removed from her office very quietly, and no one in Hollywood covered it. And now there's a Discovery person that is in that role. Hollywood trades have not covered this. That Park Place has covered it. If you're following the website and you want what's actually going on in Hollywood, maybe you should consider going over there and checking that out. But
that would be a good idea.
They absolutely do not. Hollywood hates Warner Brothers right now, which is fascinating to watch because they're putting all of their eggs into the Disney basket, which is not a good basket. It's got holes.
We're going to hear that. We're going to hear that in 2 weeks, Jonas, on the earnings call, aren't we? All those same people, the folks from Morgan Stanley, like Ben Swinburne. You'll have the folks from Moffett Nathanson and all this, and they. It's very rare. I'm not going to say it never happens because we have heard some good questions over the years, but they tend to be far more laid back and reserved when really pushing things with Bob Iger. But again, we've got in the first quarter for Disney, we've already got 2 massive failures at the theater: Captain Falcon DEI and Snow Not White. And you've got Thunderbolts coming out in a couple of weeks. Actually, Thunderbolts, and this will be interesting. Thunderbolts is going to release about 5-6 days before the earnings call. So by the time we get to the earnings call, because Thunderbolts comes out May 2nd, I think the earnings call is May 8th, if I'm not mistaken, 7th or 8th. I think it's 7th.
Sounds about right.
Yeah. So by the time we get to
the 7th at 8 a.m. Eastern.
Yep, the Wednesday. Yeah. I mean, we'll already have a good idea of what Thunderbolts looks like, and they'll probably have a pretty decent opening weekend, and they'll probably tout how great they think it's doing. But of course, Nobody on the earnings call is going to remember what usually happens to Marvel films, that by the time they get to the second weekend, which will be a day or two after the earnings call, that's when the movie just falls apart. So, but again, here is Disney going to have a mea culpa moment on the earnings call about Snow White? Granted, probably most of the questions from the analysts on the Disney call are going to be about, what are your expectations for theme parks this summer? And how much PP have you released into your pants about Epic Universe, because they're about to trash you? Disney's no longer going to be the preeminent, most advanced, most creative, most brilliant, most immersive park on earth. It's done. It's done when Epic opens on May 22nd. It's absolutely done. What's going to happen to Disney's market share in Orlando once this park at Epic really takes off? But, I would love to see something like this. Where and again, Michael DeLuca and Pam Abdi, they did what their heads were on a chopping block until Minecraft came out. If Minecraft had not performed, these two people may not be at Warner Brothers right now. If we had gotten a different story with Minecraft's release and it only maybe turned in $400 or $500 million globally over its whole run, they would be in trouble. But good on them for coming out and saying, yeah, look, we really screwed up. They got to make the boss happy. They got to come out and say, hey, you know what? We should have listened to the boss, man. The boss was right all along about Joker 2. I would love to see Alan Bergman have to come out, or Bob. But the thing is, what's the difference between David Zaslav took one look at this movie, right? He watched it once, one of the early cuts, and went, ooh, really? Okay.
They hate it when normal people watch their movies.
Yeah. What's the difference?
I'm not calling David Zaslav normal. I'm not. But
no. I know
he's not a Hollywood person.
He's not. But here's the thing: how many times does Bob Iger watch, according to him, every movie that comes out of Disney before it releases?
4 to 5 times. My goodness, I still can't believe he ever said that.
Right, and this is the difference. David Zaslav looked at this movie and he said, I don't know about this, guys. I'm not with you on this. But ultimately he went and trusted, because Zaslav is not a Hollywood, mindset person. He trusted DeLuca and Abdi. Okay, y'all really sure this is going to work? I don't think it's going to work, but y'all go ahead and try it. It flopped. Zaslav was. The difference is Iger looks at Snow White 4 to 5 times and goes, this is great. I can't wait. That's the difference. Zaslav saw one early cut one time and said, bruh, really? Imagine Bob Iger would have sat and watched this Joker 5 times if it had the Disney logo on it and approved it. So that's the big difference. That's the big difference between a studio like Warner Brothers that's being run by a guy who just, can we make money over here? That's what David Zaslav wants to do. And he's from where he's, remember, this Zaslav was brought in to completely turn Warner Brothers around after it was spun off from AT&T. And everybody knew, or should have known. We talked about it when it happened. We've been covering this since 2022 when he first took over in May, actually right at 3 years ago, next month. This is going to take several years to fix this thing, Now, hopefully we get to summer and, for Warner Brothers' sake, Superman's going to be a big hit, because that will certainly be, Superman is really going to be the first major piece of IP that would have been initiated under the Zaslav regime, right? With him bringing in James Gunn. This is, so we'll have to see where this goes. But again, I found this story fascinating to me, and what an absolute divergence from what we see from Disney in terms of how they handle things. So anyway, let's see. I got a couple of more chats here, and then we'll wind it up. John Thomas for 5. Why doesn't the SEC have a rule requiring live questions from shareholders during annual and quarterly events? First come, first serve. I don't know. That's probably a bit too deep in the weeds for them. I don't even know if there's a requirement that there be questions, like a Q&A session at an annual shareholder meeting specifically. Usually you have a vote. Shareholders can be present to vote. They can open up the floor for shareholders to speak their minds about certain ballot initiatives, certain things that they're voting on. But I don't know the specific rules the SEC has about that. And I don't know if they would change it. Doge for 5. A lot of animation stands also hate David Zaslav, but they fail to recognize that he is the consequence, not the cause of the Warner Brothers Cartoon Network downfall. That is true. That is, again, all of Warner Brothers' problems that have still persisted for the last few years, even since David Zaslav is there, have been held over from the previous regime. You do not change this overnight. It's the same, things that we've said about Disney for years. The fact that Bob Iger and the fact that people still let him get away with this, Wall Street analysts and otherwise, get away with the fact that Disney was fine and dandy, but for the 10 months and 2 weeks that Bob Chapek had that, according to him, sunk the whole planet, which we all know is bull crap, right? And so it's the exact opposite. You have to look at it from that standpoint, at least in terms of what Iger tries to get across. It's like, no, it was all the stuff that Iger had done for years and years and years leading up to where Bob Chapek came in, and all of that stuff was already in motion, right? And he just got the crap for it. So, anyways, Jonas, any final thoughts you got there?
No, I'm looking forward to seeing what Comcast does, and I think it'll be interesting for me as a customer of Comcast at the moment. I am considering switching, but maybe if I can get a 5-year lock-in of a reasonable rate, they'll cut me some slack here, and I'll stick around. I think that the theme park business over the next little while, we'll be watching to see what happens. I think they've got, whether or not they beat Disney on straight numbers, which I think is kind of an impossibility based on the capacity that they have at Disney right now. I think they're going to be the premier destination for the foreseeable future. They have a brand new, shiny theme park that everybody wants to get in. And the complaints that I've heard, there was a pixie duster out there complaining about the alcohol at Helios. That's about the only thing that I've heard a real complaint about there. And okay, I'm sorry, it's not your favorite bar. Go back to your real favorite bar, your $200 a day Epcot over there, whatever. Right. I think Comcast has good things going on right now and room to grow and give Disney trouble, which is good for everyone, including Disney. Keep lowering those prices, Disney. Also raise quality.
That's the key. And we talked about that. We've seen Disney's response has been to, offer some massive discounts on certain hotels and whatnot for the summer, which everybody that follows it pretty avidly has said they have not seen Disney do this in forever. So they must really be in trouble. Meanwhile, people cannot fork over money to Universal for this summer fast enough. So I mean that's been a big part of the problem. Right, my camera just freaked out. That's the first time it's done that in a while.
This is my show now.
Yeah, exactly. So anyway, we'll talk more about that this weekend and for the Disney earnings call. So want to thank everybody for being here. Appreciate y'all hanging out with us, especially early in the morning. William Thompson for 5. Why is it when I hear Comcast earnings call, I'm ready to buy, but with Disney, I'm ready to sell it, and I don't even own the stock? No financial advice here, but yeah, I get you. Doge for 2. Learn about Rebecca Sugar for a cause of, I guess, Cartoon Network's fall. Well, have to check into that one. I'm not real sure about that one. I don't know that one. All right. Well, we're going to get on out of here. And y'all have a show coming up soon here, huh?
Yeah. At 11 o'clock, Morning Magic will be doing an episode here talking about everything that's going on with the parks. Right now, Disney has been dethroned from the #1 animation spot. We're going to talk about some of the recasting in Toy Story 5. And it's apparently going to be about Jessie and whether or not it's the best time or the worst time for Epic Universe. Oh, and they, oh man, I know I'm saying this on the wrong show. They gender swapped Holes for Disney Plus. So
anyway. Well, that could mean 2 things. I have no idea. Okay, never mind. That is I don't understand.
The Shia LaBeouf movie that had.
Yeah,
him
I
and
remember
Sandra in
that.
it.
So like, oh wait, oh, you know what? I know. Okay, I did see that. So like, all the main characters now are chicks.
Yeah.
Yeah. Okay. Which
So
again,
interesting.
This is Hollywood stupidity, Disney stupidity. We could take the same property that we made 20 years ago and just stick girls in it, or just stick people that aren't white in it, because this is what they do. And all of a sudden, everybody's going to watch it all over again. It's going to bring in a whole bunch of new people, except that never, ever works. I don't understand why they keep doing it. It's really is. They're deliberately lighting money on fire at this point.
Yeah.
It's ridiculous. Anyway. All right, we're going to get on out of here. Go check out That Park Place for their show in just a bit. And thank you all for being here. We are gone.